And the recession is what stock market investors are concerned about. I have data here going all the way back before 1950 from fred.stlouis.org, and this is the unemployment rate going all the way back to 1950s. So what you can see here in the most recent times since 2023, the unemployment rate bottomed at around 3.4%, 3.5%, and started increasing since then. And now what you have is an unemployment rate that's above or around 4.3%. And I wouldn't be surprised when the Labor Department, following the government's shutdown, when it actually reports the most recent labor data, that we will see perhaps unemployment rates ticking higher. Now, it has the unemployment rate, the way it's calculated, sometimes even though there's poor job growth, the unemployment rate doesn't increase because the unemployment rate measures the labor force participation rate, which includes people that are looking for work. So people that have been discouraged and stopped looking for work, they're not counted in the labor market, so they don't work against the unemployment rate. Furthermore, there's been an increase in immigration enforcement and the population decline, and the decline in those individuals creates a decrease in the labor supply, which could then stop or decrease the impacts on the unemployment rate because you don't have as many individuals looking for work. But what you can see here, going back all the way to 1950, is once the unemployment rate starts to increase, we usually have a recession that follows the increasing unemployment rate. You can see that back here in 2007 when we started to have the increase in unemployment. These gray shaded areas indicate a recession and unemployment rates surged. And same thing when the 2020 pandemic, there was a recession, but it's kind of an outlier, so we won't talk too much about that. Then you have the 2000, the dot-com bubble, and you had the unemployment rate increasing, then you had a recession. 1990, you had the unemployment rate increasing, then you had a recession. 1980, 1979, 1972, 1969. All of these indicate that when the unemployment rate starts to increase, it goes into this negative virtuous cycle that leads to a recession. And you can understand why that happens, right? So once the unemployment rate starts increasing, that's fewer people going out and buying cars and going out to eat, which then causes businesses to slow down hiring even more because there are fewer people buying their products.
Click the link below to watch the full video.